In this week's update, risks we need to prepare for and manage, stock picking with a clear plan, and gold surges. My name's Garry Davis. As always, this is general advice only, and please remember to like and subscribe to the video. All right, short and sweet this morning. It ended up being a positive week, particularly in America. But if you want to step back, which is, the part of the purpose of these videos, step back and just get a perspective on the market rather than just being too close to the day-to-day action and see where the real returns are coming from. Now, if you look at the ASX 200 accumulation index, then it's up 5% year to date. So in 6 months, it's up 5%. But around half of that is contributed by dividends. So if that's the pond that you're fishing in, then that might be okay for some investors, but I know for a fact that it's not okay for most investors that I talk to. They're looking for more than that. And so if you want higher than 8-10% a year, which is what the indices broad-based investing strategies, which is widely recommended, will deliver you, or you in fact need well above average returns to make all the things work, then you're certainly not going to find it in a broad-based approach to the top 200, unless you know how to be a really good stock picker. Because the answer to getting really high returns or well above average returns is in high probability and strong growth stocks. So there's two words there that are key. One is strong growth, and also that strong growth is highly probable. There are lots of companies that have the potential to deliver strong growth, but they never get around to doing it. And they're the ones that investors tend to get their fingers burnt on very badly. You also need to go with that. It's not enough just to have the targets in mind. You've also got to have a very strong and repeatable entry process. I talk about this just about every week, and a management plan that is suitable for your psychology. So that means it's not a one-size-fits-all kind of situation. And if you are taking a model that someone else has generated as being suitable for you, then the chances are extremely real and high that you're going to end up with a model that doesn't actually work for your psychology. So it's really important to start from the grassroots. Now, for those of you that aren't terribly experienced in investing, that might seem like a daunting task because you feel like you don't even know what questions to ask. And that's probably a fair statement. So you've got to get some assistance on that. But I can assure you that it's a very simple and very quick process to devise and also to manage. It just requires a little bit of discipline. It's no big deal. Now, the American stocks, the S&P rose almost 2% across the week, but the NASDAQ really sizzled on Friday and ended up 3.6% higher. But those very robust gains were the exception, not the rule, because the equal weight S&P index, so if the S&P index as you normally see it reported, is what's called a market cap weighted index. And so there is extreme contribution from the small number of very large stocks. But if you just do it on straight averages, then the RSP, the equal weighted index, was actually down 0.4%. So that tells you a lot about what is happening underneath the surface in the US. Now, on Friday, the non-farm jobs report certainly signaled that what the Fed strategy has been trying to do is working. There's certainly, the economic data is moving towards the Fed objectives. And of course, that means that a rate cut is more likely than it was a week ago, a month ago. Also on Friday, we saw what are probably the start of some pre-earnings moves in big tech. This normally happens in the month leading up to the start of earnings season in America. We see some very, very positive moves, and we'll have a look at a couple of those. So they certainly fueled the big rises in the indices. But if you look at the rest of the US market, it's nowhere near as pretty as those percentages would indicate. But look, I present that not as a negative comment, just a cautionary comment. What it means is, to me, that I don't need to stay clear of the market. I just need to stay clear of most of the market. I need to keep doing what I've been doing for years, and that is just focusing on the stocks that have got strong growth and highly probable growth, and it just keeps working. You have your ups and downs. You take 2 or 3 steps forward, you take 1 step back, but that's just all part of the process of investing. If you focus on a small sliver of the market, you can do extremely well no matter what else is going on around. US dollar index was lower for 88, of course, with the higher prospect of a rate cut. That also brought the 10-year yield down to 4.29, and the VIX has still been hanging around this sort of 12.5 level now for quite some time. Let's go look at some charts. There's the S&P, heavy contribution from big tech. So this is a weekly chart, so you can see it was about as positive a week as we've had since the lows in November last year. So that's all extremely positive. There's one other ratio chart that I'll show you. This is US large cap growth versus large cap value. And a rising line means, of course, that growth is beating the pants off value. And to the frustration of value fund managers who use the theory that if you buy stocks that are undervalued, then over the long run you'll do well. And that is probably true, but the market seems to be shifting in the last 5 to 10 years so that value stocks have been lagging now, and certainly in Australia, small cap value stocks have been lagging now since pre-COVID. And so, the clock has been ticking for a long, long time for these so-called value stocks to improve, whereas growth has just continued to march on very, very impressively. There's the RSP, the equal weight S&P, so you can see such a stark difference between that and that. It's really quite graphic. And there is the Russell 2000 looking very similar to the equal weight stocks. All right, now really importantly, one of the most important stocks, mainly because of its impact on sentiment. If NVIDIA goes into a correction cycle, which it will at some point, and I'm not saying whether now is yet because this chart is a bit indecisive for me, it could go either way. But if NVIDIA were to go into a correction phase, we could get it down here under 100, and that would have a big influence. It would have an unfairly large influence on the general market sentiment. Shouldn't be this way, but it's just how it is. So that's why I'm sort of terming NVIDIA the big influencer, because I think it'll have an outsized impact. It's gone up so much, and there's been so much in the media written about NVIDIA. But look, NVIDIA's got plenty of mates. This is Meta. Huge finish on Friday, and look at the volume behind that. Look at Microsoft, very similar, not so much on the volume, and Google also very, very strong. And of course we've got Tesla was up very, very powerfully for the week. So that is a lot of what is driving the US indices at the moment. SMH, always important, semiconductors. If semiconductors are doing well, the market is not going to fall over. And certainly the semiconductor sector is doing quite well. And there's the NASDAQ on a weekly chart also. All right, so let's look at some relative comparison charts over the last quarter. Again, all we saw was an extension of what we looked at last week, with XLK continuing to move ahead of the rest. Also XLC, which is communication services, is accelerating again, and also consumer discretionary, which is certainly a lot about Amazon and Tesla. I haven't looked at the weightings of those two stocks in the last few months, but going back to the start of the year, Amazon and Tesla contributed to 40% of XLY. So it's not really an index that you can, you can't look at that and say, the consumer is doing well in America, because it's really very much about two stocks. But interestingly, we're still getting strength in staples. So it's a very weird market in that sense, that the top stocks are the most defensive and also the most aggressive at the same time. So that indicates that this is a market that's comfortable with high-level stock picking, and they're not terribly worried about being overly defensive or overly aggressive. It's just about picking good stocks. If we look at Australia, the information technology sector is just going sideways a bit. Healthcare has certainly picked up. Banks haven't fallen off yet, but as I've been saying for weeks, there's no value in banks. They won't necessarily fall, but we're at a point now where the upside compared to the possible downside is very, very unattractive. Okay, so that's it for the charts. Let's go and look at what happened in Australia. Our dollar 66.85, so certainly helped a lot by what happened with the US dollar. Our market ended up 0.7 across the week. I don't know whether the Australian market is now focusing on the S&P 500 or whether it's focusing on the RSP. And, that in large context might explain why the Australian market in general is lagging to such a degree. Energy was up strongly with the oil price moving ahead. And we did see a partial recovery in materials at the end of the week. It's been significantly underperforming, but did pick up with iron ore at the end of the week. If you do nothing else, but just buy the great long-term wealth compounders, yes, they're expensive for most of the time, but if you buy those sort of stocks on weakness, if you did nothing else but that, you would beat the averages. But you've got to be able to buy them on weakness. So it's simple, but it's hard to do. And the reason that it's hard to do is that, first of all, you've got to have the courage to buy stocks that appear to be very expensive, and everyone tells you they're very expensive. Secondly, you've got to buy them on weakness. And when you're buying a stock on weakness, you need to have great conviction about where that price is going in the medium to longer term. You need to have great conviction that there's not much downside from where you are buying. And unless you're immersed in the market, it's a pretty tough thing to do. So it's a very simple concept, but 99% of investors are going to need help with that. They need the perspective and the confidence of someone else to pull the trigger. But if you did nothing else but that, you would do well. However, you can do even better than that by mixing it up with some other really good opportunities. There are some terrific Australian stocks that are moving ahead very robustly. They'd certainly be in the small cap category, and they're moving ahead really, really strongly because they've got great growth, and the market from time to time starts to understand that that growth is reproducible. It's going to continue for a lengthy period of time. So there are other stocks that you can build around those key wealth compounders that allow you to do even better and get up into the realm that only a tiny minority of investors can consistently produce. Let's go and look at the Australian market and the currencies. Just first of all, we'll have a look at the currencies. Here's the US dollar index. Certainly came off Wednesday, Thursday, and Friday. And we got a couple of gaps in there. And the Australian dollar went very much the other way. So really just inverse mirroring the US dollar. And if we look at the ASX 200, not a lot of change. It's pretty boring, really. This is a weekly chart. And it's at the same level that it was at in March. So effectively, no growth in the ASX 200 or a broad-based investing strategy in the last 4 months. That's pretty graphic. All right, while I'm here, let's look at the precious metals. Silver on a weekly chart broke out very robustly above $30 and then has weakened over the last 6 weeks, got down under $30, got down slightly under $29, but turned around last week. And a lot of it occurred in the latter half of the week, Wednesday and Friday. So it's looking very positive again. But having said that, and the same thing applies to Australian gold stocks, there is enormous diversity amongst the Australian precious metal stocks in terms of performance. The majority are not doing much, particularly the developers, whereas there are a small handful of stocks that are doing extremely well. And I'll come back to that when we get to the slide on precious metals. Here's the US dollar gold price. So you can see we had a real surge. And again, a lot of that occurred at the end of the week. That's really with that jobs report data out of America. So you can see we're still sort of lurking. We're only a whisker off the all-time closing highs, which was 2414 back in May. So we're at 2390. So we're only $20 off the all-time closing high. So that's still looking very positive. Look at it in Australian dollars. We had a bit of a tick up on Friday, but left it could be because the Australian dollar went up as well. Okay, let's get back to the slide. So precious metals, gold added 65 to be just under 2,400, and silver, of course, back above 31. In America, it's really a combination of the softening labour market, and that's what two data points in America last week told us, that the labour market is softening. Unemployment rate is ticking up a bit. Number of new jobs added is ticking down. There's also moderating wage growth, so that's taking the pressure off inflation. And all of this is happening without a recession. So irrespective of what you think about the performance of central banks, and a lot of them screw it up a lot of the time, but putting that aside, it would appear that the Fed has done a pretty damn good job this time around, because it's highly unlikely that the US economy is going to slip into recession. But nevertheless, the Fed is more likely now to cut rates, probably in September, to make sure that they don't allow the economy to slip into recession. And so this is all really good for markets. Interest rates starting to come down, top of the cycle, but without recession, you couldn't write a better script for the sentiment of the market. Precious metal stocks in both countries, Australia and America, as I said earlier, it remains a very highly bifurcated market. This is a stock picker's market, just plain and simple. If you don't know how to select the best stocks, then you're likely to end up with lemons. I think it's about as stark a contrast as it could be. I'll just take you back to GDXJ. So we're starting to see a bit of a move in the global gold producers. This is GDXJ. So this does include stocks like Evolution Mining and Northern Star. So we are getting a bit of a breakout. We are getting some higher highs and higher lows, but it's painfully slow. There are a few exceptionally good gold and silver stocks in Australia that are outperforming this index by an absolute country mile. Okay, moving on to other commodities. Copper was up sharply. This is really more about the currency up to 465. Nickel didn't move much. So certainly with copper, it was a lot about the US dollar. Crude oil was also up 83.5. There's the spot copper chart, so quite a sharp recovery last week. And there's the crude chart continuing to fluctuate in this band between 70 and 90, and it's towards the top end of the band. And I really have just about zero feel for where crude oil goes from here. Could go to 100, could go to 70, probably unlikely to go below 70. But I just find the energy market in Australia so difficult, and the returns are anything but appealing. So I just tend to leave the Australian energy market to itself. Wrapping it up, the scary media articles are back. There's a lot of them coming through. And you've just got to say, well, is it going to serve any purpose? And of course, you can't have investing success if you pay attention to this stuff. It's being written to capture eyeballs and to improve their ratings. So if you pay attention to it and are influenced by it, you are almost certainly going to be back in the pack with everybody else with, ordinary returns at best. Sure, filter it, don't ignore it. It's stupid to stick your head in the sand and not be engaged with what's going on. You've got to be engaged. So read it, filter it, assess it, whether it could impact your process or how it would impact your process. But beyond that, just ignore it. In fact, I get really comforted by it. Articles about doom and gloom just reinforce to me that if that's what the majority are thinking, then that's not what I want to be thinking. I want to be on the opposite side of that sentiment. So it doesn't bother me in the slightest. Portfolio analyst last week, it was a taking stock week. The first week of the month is an educational exercise looking back at things that we've done, things that we've talked about in the previous month to see what we can learn and get better as investors from that. And what we covered was a really important topic, and that's recognising and acknowledging when the game has shifted. And there certainly are some shifts underway at the moment. So that was a really important topic. And we also looked at lithium. Nothing terribly positive came out of that at the moment. I don't know when it will be that lithium will get back on the positive train, but it's something that just has to be monitored at this stage. So that's it for this week. There is more information on the website. There's my email address, and I'll be back with you next Sunday. Cheers.